everybody, welcome to another unit of Financial Management, Unit 4. Unit 4 will talk about secondary books. Here in this unit, we'll understand what are the secondary books, what a purchase book or purchase day book. We'll understand the difference between cash discount and the trade discount. We'll also analyze the sales book or the sales day book. We'll analyze this bills receivable and bills payable, and at last posting of ledger account. Here we start. First, let's understand what is secondary book. The journal is a book of original entry, and only one journal is maintained if the business is very small in size. However, if the transactions are multifarious, then subsidiary books, which are known as books of original entry, are prepared. Right? So originally, if you see, there is only one book which is maintained, that is called as general. However, if you have the business diversified and multi-transactions business is maintained, so you have to maintain the subsidiary book for this, and those are the subsidiary books, the types of subsidiary books which are known as purchase book, sales book, purchase return, sales return book, bills receivable book, cash book, and general proper. We'll understand each books in detail. First, let's focus on what is purchase book. Purchase book are also called as purchase journal. In purchase journal, only credit purchase of goods are recorded in this journal. And what are the goods? The goods means items or commodity procured for resale. Cash purchase are recorded in the cash book, and credit purchase are recorded in the purchases book. Always remember, as an entrepreneur, as an accountant, you need to record all your cash transaction in a cash book and all your credit purchase in a purchase book. Now what happens? There are two forms of purchase book. In the purchase book, we record two different type of transaction. One is trade discount and cash discount. However, the format of purchase book will have date, invoice number, name of the supplier, LF, that is ledger folio number, details, and the amount. I'll repeat: date, invoice number, name of the supplier, LF number, details, and amount. However, there are two transactions under the purchase book which always reflect the first thing, which is called as trade discount. What is a trade discount? It is a reduction granted by the supplier from the list price of goods or services on business consideration. For example, if I want to have a cash, I can offer a discount to my purchaser. So if I get a cash discount, I offer certain discount. These are called as trade discount. For example, if 5 gold coins are sold at the list price of 15,000 each, subject to trade discount of 12%. So the trade discount will be calculated as, I'll repeat, if I have to sell 5 gold coins at the price of 15,000 each coin, and I have to offer 12% trade discount, so how will I calculate? 5 gram gold at the rate of 15,000, that is 15,000 into 5, that becomes 75,000, less trade discount, that is 12% of 75,000, that will become 9,000. So what I'll do is, I'll reduce amount minus the amount 9,000, that is trade discount, from 75,000. The actual amount will be 66,000. So amount payable as per invoice is 66,000. Next is cash discount. Cash discount, it is a reduction guaranteed by the supplier from the invoice price in consideration of immediate payment or payment within stipulated period. Right? That is cash discount. So what happens? Here again the same example we will take. If 5 gold coins are sold at the list price of 15,000, subject to trade discount of 12%. The invoice price after trade discount is 66,000 as we discussed earlier. So what happens further to that, cash discount terms are 2% for 30 days. Assume you are getting an offer of 2% more additional discount for 30 days. This denotes that the buyer will get 2% cash discount if he makes a payment within 30 days. So how we calculate this figure now? As usual, that is 66,000, the figure that we arrived earlier, that is 5 coins into 15,000 each, so it becomes 75,000. Less trade discount 9%, 12%, that is 9,000. So actual amount, invoice amount is 66,000. From this 66,000, we will now reduce a cash discount of 2%, that is 1,320 rupees. That is 2% of 66,000. So cash payable within 30 days would be 64,680. Right, friend? So this is what is a cash discount. Now, if I have to say the difference between trade discount and the cash discount, so the trade discount is allowed to promote the sales, while cash discount is allowed to encourage early or the prompt payment. Right? And trade discount may vary with the quantity purchased, while the cash discount vary with the period. Trade discount is shown by way of deduction in the invoice itself, hence no further entry is required to book the account. However, cash discount is shown as the expenses in the profit and loss account. Alright friends, so we have discussed trade discount and cash discount. We'll move further now. As we discussed the subsidiary book, now the another subsidiary book we are discussing is the sales book. What do you mean by the sales book? As the name says, sales book or sales day book are the same. Sales book contains the details of credit sales of goods made during a particular period. The total of sales book is transferred to the ledger, and this is called a sales account. The parties to whom credit sales are made are known as trade debtors, right? So the parties on whose name we have sold the credit product, that is called as debtors now. And all debtors are classified at personal account. All debtors are your personal account, and for each party, ledger account is prepared in the ledger. Sales account shows credit balance and the debtors shows debit balance. Right, friend? Now the sales can be of outward sales or sales. Right? There are two types. We will now discuss what is purchase return book. What is purchase return? That means anything that you purchase and you have returned. And this return can be for any reason. Right? Like when the business person purchased the goods and find they are damaged or not as per the specification, he might return the goods. And he will return to whom? To the supplier from whom he has purchased. So all these purchase return are recorded in the journal called as purchase return book. Normally in this account what happens is supplier's account is credited when the purchases are made. If the goods are returned, then the debit note will be sent to the number of debit note is recorded in the purchase return book. Right? So anything that you purchase, you return it because of any reason, might be because of the cost variation, because of the defect in the product, because the product of expiry, it will be purchase return. Right? We will now move to sales return. As the name says, sales return, anything that you have sold and it has come back to you, is called as sales return. So sales return book is also known as return inward book. I'll repeat, sales return book is also known as sales book or return inward book. So sales return book is open for the purpose of recording the return of goods sold on credit. Here what happens, a credit note is prepared to show that the customer or the debtor's account is credited to the extent of the value of good returned by them to us. and goods are received from the customer and a credit note is sent to them. We will go next, that is bills receivable. What is bills receivable? When a business person, when you as entrepreneur, you sell a goods on credit, the proceeds is received at the later date, not immediately. It's sometimes you might receive later also, sometimes it is on the immediate basis also, depends from situation to situation. Suppose the business person require cash immediate basis. Now what you will do? You may opt to draw a bill of exchange against the customer, right? The duly filled bill of exchange is sent to the customer for his acceptance. Now what happens? Your customer will accept by way of putting his signature on this bill of exchange and he will send it back to you as a business person. Now what do you do with this bill of exchange? On the receipt of the signed bill, business person discounted from the banker or the commission. You as an entrepreneur, you will take this bill to the banker and you will say, hello, see, this is the amount what I am going to receive. So bank will discount that, right? And the business person, that is you, will receive 90% of the bill amount on discounting. That is nothing, bills receivable, right? So bill of exchange is a document in writing which promise to pay a certain sum of money or money worth to a drawer at a certain date or a value received, right? In the business terms, who draws a bills of exchange is called as drawer, and the customer on whom it is drawn is called as drawee or an acceptor, right friend? Now, after bills receivable, we'll discuss what is bills payable. Bills payable what is bill receivable for a drawer? Is bill payable for the drawee. Whatever is the receivable for a drawer is payable for the drawee. That means when you purchase goods on credit, you need not have to pay it for immediate, right? So instead what you do? You accept the bill of exchange from a drawer by the supplier. And all these bills are accepted by the business person, are recorded in the separate book that is called as bills payable, correct? The sum of the value of the bill payable for a period ending will transfer to the ledger account, correct? And that's how you will reflect the entry into the general or the ledger. Right? So bills payable is nothing but bills receivable of a drawer is also bills payable for the drawee. Right friend? We'll move further. Cash book. As the name says, cash book. Cash book is an important subsidiary book for every business person. And the book of original entry. It is a record of cash receipts and cash payment made during the particular period. Here what happened in this register or in the cash book, you have two sides, that is left side and the right side. On the left hand side, receipts are recorded, and on the right hand side, all the payments that you made are recorded, right? A simple cash book has two sides, as I said, that is receipt side and the payment side. The receipts are on debit side and the payments are on credit side. So it's just a ledger account. The word to and by are used because to is on the left side and by is on the credit side, right side. So cash book containing cash in the bank column is known as two-column cash book. Sometimes you have cash also, you have bank also transaction. So what happens? You maintain this cash book into two columns, left and right, and every even left and right side will have a two columns for the amount, that is cash account and the bank account. When you make cash and bank in the same book you enter, this is known as two-column cash book. In the case of three-column cash book, on the receipt side, cash, bank and discount allowed columns are also stated sometime. So it can be of 3 column also, that is cash, bank and discount. It can be maintained 3 things in this. That is what is the cash book is all about. Coming to petty cash book. Now what happens in a large organization? Petty expenses like day-to-day expenses from stationery, postage, stamps, refreshment, carriage, cartridge, daily wages, etc. That is a recurring cost has been maintained, right? And it is incurred on day-to-day basis. And all these expenses are more in numbers and very significant in value. So to look after payment of such expenses, what normally an accountant do is a separate petty cashier is appointed who can maintain the books. That is called as petty cash book, right? Any question on petty cash book? What we discuss now is secondary books are different types. We discuss purchase book, sales book, purchase return book, sales return book, bills receivable book, cash book and general proper. And purchase book, we discuss trade discount, cash discount, we discuss sales book, we discuss purchase return, bills receivable book, bills payable book, cash book, petty cash book, right? Now we'll discuss what is the posting of, how is the posting of ledger done. Now what happens? The next important stage for any accounting is preparation of ledger account. And this book is called as ledger. The book contains summary of transaction concerning to various heads of account for a given period. Postings are made to the ledger account for the from journal entries. And what are the procedures for balancing the ledger account? Here always remember in the ledger the both debit column and credit column should be maintained. You have to total both the side. And if debit side total exceed to the credit side, what happens? Such difference. So if the debit side exceeds the credit side, that means credit side is a shorter. So what you do? Put such difference called as debit balance on the credit side by balance carried down, C/D. If the credit total exceeds debit part, such difference that is called credit balance on the debit side and we write as to balance carried down, CD, C/D. Now total both the debit side and the credit side of the account, and after that enter the date of the next accounting period, bringing down the balance of the previous accounting balance. That's how we maintain a ledger account. That's how we maintain or enter the posting. Any question in posting of the ledger before we summarize today's learning? So let's summarize today's learning. We have discussed today about the posting of ledger. We discussed various purchase book, various secondary book, and we also discussed trade discount and cash discount. Any questions? Alright friends, thank you and have a great future ahead. Enjoy your learning of financial management.